Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for December 20th, 2022. It's our last show of the year. I'm Ken Adamo, Chief of Analytics over here at DAT, joined as always by Dean Croak, who's our Principal Industry Analyst, and we have a very special guest to end the year. We have Dr. Jason Miller, who runs the supply chain program up there at Michigan State. Good morning, gentlemen.
Good morning.
Good morning.
I didn't catch it in the news, Jason. What bowl game is Michigan State playing in this year?
Let's not talk about that. Cheering for my alma mater of Ohio State right now, to say the least.
Yes, the Peach Bowl. So I'm looking forward to that. I'm not optimistic about what's going to happen on New Year's Eve, but it'll at least be fun to watch, I think. I hope. Maybe. I always forget that you did your undergrad at Ohio State.
Yeah, no, it's weird being, the Big Ten rivalries. We always joke that so many faculty at Michigan State have PhDs from Ohio State for the fact we come pre-trained to hate Michigan, so there's no socialization necessary. Just automatically in there with that.
We had Matthew Leffler on right around the time of the Ohio State Michigan State game, and that ended poorly for the Spartans, as we all know. But
yeah, it's been a rough year up here.
Yeah. Do you want to give a quick intro, Jason? I know you've been on before, but we have folks that join all the time new to the show. Do you want to give a quick intro before we dive into things?
Yeah, of course. So hi, everybody. I'm Jason Miller. I'm the interim chairperson for the Department of Supply Chain Management up here at Michigan State. Most of my research focuses on the trucking sector, and then I play a role as an advisor for various government agencies on macroeconomic issues.
Awesome. So go ahead and get your questions in the chat and comment section below, and we will get to those at the end of the show when we bring Jason back. But right now, I'm going to get to our key points of the week so we can get rolling here. So typical spot rate surge absent as excess capacity keeps a lid on things. We are still seeing relatively typical seasonality. I think it was a bit delayed, so the pattern's been very, very interesting this year. But we're certainly seeing elevated rates, and that break in fuel has certainly been helping things out a bit. But Dean notes here, national average for all equipment types still about 16 cents higher than in 2019. So that's a lot of headroom, which is good. Active dry van contract rates flatten at year end. It's 8% below rates. So, we're really hoping to see things bottom out in Q1 or Q2 of next year and start to climb back out. So we're seeing all of the signs we would expect to support that hypothesis. Michigan State's truckload ton mile index, we went straight to the source for this episode. So if you have any questions, you can ask Dr. Miller towards the end of this episode. Down 1.5% month over month and up 0.8% year over year. And lastly, named aptly after my oldest son, Winter Storm Elliot's going to bring Arctic temperatures, blizzards, and travel delays to a large swath of the country, as well as extraordinarily frigid temperatures blowing into my neck of the woods. But to catch up in more detail, I'll turn it over to Dean to go through our market update. Dean?
Yeah, thanks, Ken. We'll have a quick market update. The written long-form version of this week's report will be on dat.com/market update this evening, so you can catch all of the details there. Just before we get going, remember, flash freeze this week on Friday. This storm is going to bring a lot of ice to a lot of roads in the northern tier of the country. Everybody be extremely careful. So let's start off our market update with the dry van load to truck ratio. Load posts were uncharacteristically flat last week. Typically, we'd normally see spot rates in the dry van sector up by about 10% week over week, but not so this year. Carrier equipment posts remain at their highest level in 6 years. As a result, the load to truck ratio inched up slightly to 3.0 from 2.78. In the refrigerated sector, load posts at their lowest level in 5 years last week, and volumes were around 60% lower than this time last year. Carrier equipment posts also at their highest level in 6 years. Load to truck ratio up slightly to 3.93. And in flatbed, load posts were almost 4 times lower last week than this time last year, even though they did inch up slightly week over week. Carrier equipment posts at their highest level in 6 years, similar to dry van and reefer. Load to truck ratio up to 9.52, the lowest load to truck ratio for flatbeds in the past 6 years for this time of the year. Having looked at a couple of markets, dry van capacity along the southern border tightened last week. It's been tightening for the last few weeks, up 3 cents a mile to an average outbound rate of $1.82. Remember, folks, these are line haul rates excluding fuel. In Laredo, which is the largest southern border spot market, load posts up 12%, rates up 2 cents to $1.84. Loads northbound out of Laredo to Omaha came at a premium last week as that region was hit by heavy snow and blizzard conditions from Winter Storm Diaz. Laredo to Omaha at 287, 13 cents a mile higher year over year, and about $1 per mile higher than the November average on that single lane. The storm also resulted in dry van rates up by about 6 cents a mile in the upper Midwest and Northern Plains as that blizzard stranded truckers along Interstate I-80 for quite a few days. In the refrigerated sector, after loosening for the prior 3 weeks, Fresno reefer capacity tightened last week, rates up 3 cents to $1.81 per mile. Short-haul regional lanes recorded most of the gains in Fresno, with most of the out-of-state long-haul loads to the east lower than the prior week. Loads north to Seattle at 239 were the weakest in 12 months and around half this time the previous year. Denver and Phoenix loads out of Fresno at 227 and 263 followed a similar year-over-year trend to the Seattle lane. And in El Paso, reefer capacity was also tight last week at $1.60 a mile. Rates are up 28 cents. In flatbed, in the upper Midwest, as we mentioned, Winter Storm Diaz had a significant impact. Flatbed capacity tightened across the northern tier. Rates were up 36 cents a mile to $2.54. In Minneapolis, the largest regional flatbed market, load posts were up 21%. Load south to Omaha increased by 21 cents a mile above the November average to $2.24 per mile. While outbound loads in Omaha also affected by the blizzard, spot rates surged there, up by 22 cents a mile to $1.94. In the Shreveport market, again, another weather-impacted market, hardest hit by tornadoes last week. Load posts are up 27% week over week, driving up spot rates by 43 cents a mile to just over $3 for the first time in a long time. Loads from Shreveport to Houston, at $7.25 a load, were about $20 higher than this time last year. And wrapping up with our year-over-year look at spot rates, after being flat for the past few weeks, the national average dry van rate increased by just over a penny per mile last week to $1.82. Compared to this time last year, the national average is 75 cents a mile lower, but still 16 cents a mile higher than this time in 2019. In the refrigerated category, at $2.10 a mile, the reefer rate tracks closely with 2017 and 2018 levels, as you can see from the chart. Rates are up 1 cent per mile last week, about 89 cents per mile lower than this time last year, and about 13 cents a mile higher than 2019. And in flatbed, line haul rates increased to a national average at 207 last week, following a 3 cent per mile gain. Compared to this time last year, flatbed rates are about 20% or 52 cents per mile lower. And for context, last week's national average is still 20 cents a mile higher than this time in 2019. So that's it for this week's market update. If you want to find out more about what's happening in freight, go to dat.com/market update and download our long form weekly report this evening. And with that, it's over to Ken for the short-term forecast.
Thank you, Dean. So as the weeks keep ticking along here, we're getting more of a picture into the post-holiday season, which is why you're going to start to see a lot of forecast disagreement. Just a level set on what this chart is, the blue line is a historical 7-day weighted moving average going back to July 1st. This first one's for dry van. It is a long haul rate per mile excluding fuel. So as you can see, rates have bumped up seasonally as we would typically expect, if not maybe a little later than we would have expected, but they're holding pretty strong. The colorful lines, the red line is a short-term forecast, which more heavily weights near-term data. The green is our ratecast model, which is in all of our rating products. And then the yellow and the gray are blends of the two in varying mixtures. So what you're seeing here is ratecast, as it sort of has been, operating a more pessimistic outlook, to say the least. So the forecasts are pretty much all identically aligned through the end of the year. Ratecast is starting to nosedive after what it's seeing as an abbreviated return season. The short term, the red line, is again a bit more optimistic, as it has been, because it's seeing that run up over the past few weeks and expecting that to continue on. So this is why we like to show this ensemble approach. Let's head to reefer real quick. A very similar story, maybe with a little bit less run up on the green ratecast line before it tips back down. We would expect to see reefer slow down pretty much in line with dry van before we start moving produce into the early spring. Now let's go to our comic relief for the day. I don't know exactly what's going on here, but it is interesting to say the least. This is our flatbed, and the models just seem to be rather erratic heading through this time of year. This is not really a big flatbed shipping, especially with the winter storm coming. There's not going to be very many flatbeds active in that area. Keep in mind, when they're shipping flatbeds, you have to stop and check that your load's secured more often. There's often tarping and strapping and all those other requirements. And this is just a sort of a gnarly time of the year for that equipment. So that concludes our short-term forecast. I'm going to turn it back to Dean and bring Jason back for our question of the week.
Yeah, thanks, Ken. Frozen straps are absolutely no fun this time of the year for flatbed carriers, not to mention frozen tarps. Anyway, so over to our question of the week. Jason, what trends are you watching as we head into 2023?
So I think the biggest thing that I'm looking at right now is what's going on in the single-family housing space. We just had the November data released today, and it is not encouraging. In terms of if anybody was expecting, some type of immediate uptick with mortgage rates coming down a little bit, we have seen single-family housing activity fully regress to where it was in 2018 and 2019, essentially, which, while not that bad on absolute terms post-Great Recession, is still down about 16% from last year. And obviously that has a major impact on the flatbed side for moving housing, materials, lumber, shingles, and whatnot, but also on, large appliance manufacturers. Their production is almost connected one-to-one with where housing starts are. So that means less demand for steel and appliances. And so when you look at the inventory buildup as well, especially in the wholesale level, it's all connected to the slowdown of single-family housing. So my standpoint is that is the single most important sector for us to be looking at closely as we move into next year, because if housing stays, depressed from where it was in 2021, that will not bode well for flatbed, will not bode well for dry van carriers with a lot of connection to that sector indirectly.
Jason, what do you think about large civic projects tied to the infrastructure bill? Do you think that could potentially offer a bit of a hedge against some of the slowdowns in the single-family housing area?
I think it will, but that's a very different freight mix, right, than building houses. Yeah. You're not looking at moving lumber long distances. You're looking at moving a lot more, cement, concrete, asphalt, rebar. And so while that will be very good for a lot of your short haul carriers, it's not going to be, I think, a one-to-one direct substitute for those firms with single-family housing exposure.
Not your sticks and bricks that you typically see, right, with a single-family residential house.
Yep, exactly. It's an entirely different set of firms being affected. I mean, next year could be a great year for cement manufacturers and concrete manufacturers, but that's a completely different ballgame.
Right, for sure. Where do you think we'll kind of dig out and inflect upwards from a holistic market perspective? We've been sort of calling late Q1, early Q2.
That's where I'm at right now as well. Q1 is obviously the slowest time of the year for freight. We are starting to see some initial positive signs that the inventory glut in the general merchandise sector is getting, whittled away a little bit. Holiday sales seem to be fairly strong. I think, the other question really right now too is just, I think, more from a global recession standpoint, where are things at? Europe's looking more positive than we thought, but still not great. China's obviously is having horrendous COVID outbreaks right now. But I think the wild card next year is, assuming China sticks with the more lax COVID policies, they have a horrible 2 to 3 months ahead with Omicron. But what happens on the other side of that? Do we see them come out, strong demand for oil and, distillates? Does that then drive up the price for oil? Because right now that Russian cap is effectively not in place right now in the global oil markets, given where oil prices are at. But there's, I think, potentially a lot of upside risk in oil as we move into the middle of 23. And so that's, I think, something a lot of carriers need to be keeping in mind right now.
Jason, can you speak to industrial production numbers? One of the things you talk about a lot with your ton-mile index is the impact of truckload demand from the industrial sector. How do you see that shaping up?
Right now, we are seasonally adjusted trending down a little bit, which is a little concerning because this is the time of year industrial production anyway would be trending down in absolute terms. So what that's telling me is that essentially output is falling a little bit more than we would even expect with seasonality. The other thing that gets very wonky, but there's starting to be some serious concern that the employment survey that we talk about with trucking employment numbers, we talk about manufacturing employment. There's starting to be some concerns that's overestimating employment over the last few months. And a lot of that employment data feeds into the industrial production calculations. So we actually may be overstating industrial production even more. And so if that's the case, I'm definitely a little worried. I mean, steel production this year has not been what it was last year. That's very clear when you look at the big four firms. So I'm definitely a little worried. I think the real question is how do we start to see things look as we start moving into the second quarter? If it doesn't start looking a little bit more positive, then I'm going to be quite concerned.
I mean, I think it'll be an interesting time, right? Because trucking, from its fundamentals, when you parse out the macroeconomic pressures, should be on the upswing, right? So you're going to almost have opposing forces where we're already hearing way more than usual shippers telling us that they're electing to move more freight in the spot market than they would have pretty much ever. I mean, that's not really a behavior they exhibit a ton, especially big enterprise shippers. They don't. That's kind of a fallacy that they're picking and choosing what to send spot versus contract, right? A lot of the spot ends up there by virtue of tender rejection. So, the market should be pushing for higher rates. It should be pushing for higher spot rates anyway. And the contract, the downward momentum on contracts should be bleeding out of the system. So it'll be interesting to see if we do have a more pessimistic macroeconomic picture. I think it'll be interesting how trucking reacts to that.
No, I agree. And we saw, and this could be just a blip because the data has been a little bit more volatile, but the Bureau of Labor Statistics Producer Price Index for general freight trucking, long distance truckload, yes, that's actually a series that the BLS produces, actually showed a little bit of an uptick in November from October, and it was revised up 2% in October. And that's mostly capturing contract prices and how those are moving. The one thing I keep wondering is 2021 was a record year in terms of carrier profitability across the board.
Yep.
Does that mean that we have more capacity stay around than we would normally expect just because carriers built up cash reserves and they can stay around longer, which could essentially prolong the down cycle piece of it?
Right.
And so that to me is the question right now versus, how many firms do exit. The one thing that still is surprising me is when you look at the number of business applications, which are EIN number or EIN requests to the IRS to start companies in transportation and warehousing, they're still incredibly elevated from before COVID. And what's more, they're actually trending up on a seasonally adjusted basis, which makes absolutely no sense in the current freight market. Because when you look at 2019, those numbers were down substantially from 2018 when we had a down cycle. So it still seems many people want to start trucking companies, but at the same time, there's almost no doubt there's a very high rate of exits going on, especially for firms that fired up in 21 with completely unsustainable cost structures, and they only could be profitable on $3 a mile spot rates.
Yeah.
Yeah.
Sorry, go on.
Go ahead, Dean. No, go ahead.
I was just saying it's always been a very nuanced subject this year because unlike 2018, 2019, Jason, where you had the high rates and then the exits kind of fell out of that, you weren't coming off a very strong financial year. Anecdotally, last year was one of the strongest we've seen in probably three decades at least. But it's interesting for a lot of carriers today, with diesel coming down nearly $1 a mile since July 11 when it peaked. Operating costs are down about 16 cents a mile since then. at $1.96 a mile for a long haul owner operator, I'm not far off where basic line haul rates are today, even if I'm getting no fuel recapture at all. So I think it's a mixed. I think there's a lot of carriers see opportunity in the market. The rates on our top 50 lanes are about 30 cents per mile higher than the national average. So it depends on where you run. I think you could actually be well above break even today. That said, there are still carriers exiting the market because it's just unsustainable when they pay too much for used trucks. Upwards of $30,000 a year for insurance as a new entrant, on top of all of the other operating costs they've had to observe.
I mean, yeah, this is probably a mildly warm take, but I mean, I think we're seeing less total industry exits. I mean, if we could capture this, we'd be pretty good. But I mean, I think you're seeing in 19. I think you saw a lot of like the contract and the spot demand were both tepid at best, right? I think right now, with all of the driver paying, like look at Forward Air, not to pick on them, but I think they've had like 3 major driver pay increases since the start of COVID. So if you go lease on with them, like if you exit a soft spot market and go lease on with them, that's not like you're selling your truck and going back to work a construction job, right? Or go do something else. So I think total trucking demand, and your index, Jason, and a bunch of others, CAS, ATA, they all sort of paint a picture of demand hasn't fallen off a cliff. It's just sort of reorganized into different buckets.
Yeah, no, I would agree. No, I do expect that the 10-mile index will go negative year over year in November. I will be very surprised if it doesn't. So that isn't a good sign. I mean, I'm going to release on Thursday because I just completed the latest benchmarking and seasonal adjustment. That index, the newest data, does suggest we entered a freight recession in the third quarter of this year. That Q3 was down from Q2, and then Q4 is going to assuredly be down from Q3, just based on the October data. So, but it's not as steep of a freight recession as we had in 2019, Ken, as you mentioned, in terms of overall volumes. I think the one thing, too, with trucking that is sort of unique right now is it's a more dynamic environment. And by that, what I mean is there's a Census Bureau program that I use for research. It's a 21-month lag from the year of release. So we just got the March 2020 data, which for me as a researcher is like, woohoo, but doesn't matter for industry. 2019 was one of the weirdest years ever. Incredibly high rate of exits for young firms. About 40% of companies founded between March of 2018 and March of 2019 were gone by March of 2020. But we also had one of the highest years of new entry of all time between March of 2019 and March of 2020. And so I think we're starting to see that dynamic because it's, I hate to say, easier to run a small enterprise, but you're no longer as predicated on having an anchor shipper or a couple anchor shippers to provide your freight. There's so many more opportunities to find loads, through load boards, through different brokerage options, that we're just in an era of greater dynamics, which then translates to shippers needing to find ways to more dynamically access capacity. And, Ken, Dean, you've talked about this. Chris Kaplis has written about this. That's why we're seeing more dynamic procurement approaches take place, because the classic annual RFP, assign lanes to a year to carriers, and then tender based on routing guide just is not working in today's freight environment.
Right.
Yeah, I mean, I think as we head into next year, it'll be interesting to see how much of that capacity gets lured back into them. But there's a lot of fungibility now between the spot and the contract market the carriers may not have had. It was kind of there in 19, but if you think back to the last major dip, would that have been 15 heading into 16? They certainly didn't have as much optionality then as they do now. So I'll be closely watching how much of that capacity comes to, because we're seeing the frequency of the cycle compress, right? I mean, we're seeing a much tighter ups. The gap between peaks and valleys are narrowing, and the amplitude certainly went up. I think a lot of people would argue that the last 2 cycles has been dominated by non-traditional events, right? ELDs and COVID. Like, what will the next market peak look like, and what will be driving it is a question. We haven't seen a normal one in, when's the last normal freight peak we saw? 14, 15.
Yeah, 14. And even that one I would argue was still abnormal because you had fracking just go boom and bust around November when oil plunged. And so, if anything, I don't know the last time we had really a normal peak. And I mean, if you look, it was kind of after the Great Recession, sort of a slow, steady build up to that 2014 peak. And obviously the Great Recession, anybody listening, the one thing I'd say is if we're talking recession in 23, it will be nothing like the Great Recession. And one thing as an economist, every paper ever written about the Great Recession just says it was completely different than every other recession that we have data for going back to the 60s. That was hopefully a one-off lifetime event.
Right.
And so if we need to look at sort of past precedents, it's maybe more the early 90s recession with oil shocks, or some of the 80s recessions with the Federal Reserve raising rates, but it's not a global financial crisis taking place.
Yeah, I mean, especially for our listeners that don't want to dig into the academic papers, go watch The Big Short, right? It's a entertaining yet very informative view of how multiple fail-safes failed and drove the entire globe into a insane financial collapse, if you will, right? The American housing market sucking the entire world into a global macroeconomic recession. Possibly, yeah.
Well, the other thing I'd always have people keep in mind, the last two recessionary cycles other than COVID were 2001 and then obviously the global financial crisis. During that periods, that was the periods of peak offshoring. And so again, most trucking activity is still tied to manufacturing even today. You go back to the 90s, it was even more so, a few percentage points higher. But we were living through periods where a tremendous amount of manufacturing got moved from the U.S. to overseas. And obviously more imports benefited certain carriers relative to others. But we're now at an era where I think we will see a tremendous amount of manufacturing activity come to Mexico. I think the manufacturing coming from China to the U.S., that is not an attractive cost structure decision. But China to Mexico is. And so I think that we are going to see cross-border wise a tremendous surge of activity over the next 5-6 years as more manufacturing comes back. And so I think that'll be great for your carriers located in the Southwest that really can, latch into that.
Jason, we covered a little bit of this last week's show. We looked at load posts in the spot market along the southern border. They've been growing at a clip of about 25% a year for the last 3 to 4 years. So I think some of that's already started. We're seeing a lot more volume come across some of those big markets like Laredo and Dallas in particular.
No, I think so. And I think that, again, it's going to be, specific sectors where, the cost structure of this may not be quite as labor intensive. I mean, assembly of cell phones is still so labor intensive. That's going to take place in Asia. Right. But maybe some of the processes, like Mattel is having a major Barbie plant move to Mexico, or they're opening a new one there. And you think about that, that's a lot more capital intensive. Right. And it relies very much on plastic resins, for which the U.S. has a massive competitive advantage. So you start thinking what the implications are. You're probably looking at, container loads of plastic pellets moving south from facilities in Texas across the border, getting melted down in Mexico. Finished Barbies being made. Having a 6-year-old daughter, I'm very familiar with the Barbie supply chain right now. coming back across the U.S., but that'll benefit companies like U.S. paper manufacturers and cardboard manufacturers, who will be in a good position to pick up those additional, packaging material volumes, as an example.
Right.
Yeah, and I think the one thing as we end the year on a bit of a positive note is to understand that a lot of these changes we're talking about and debating about really happen on the margins of the freight industry. Like when you read a headline that talks about, this overemphasis, it's not like 90% of the trucking volume is going to evaporate overnight. And there's just going to be, every truck stop in America is going to be full of truckers, like the Wall Street used to be, looking for shipments, right? We're talking about the U.S. economy is so big and so dependent on growth that very, very, very small changes, like measured in fractions of percentages, right, basis points, can have very large implications. And that's what whips the media and, largely whips investor sentiment into a frenzy. So I would caution everyone, we're talking about, and Jason can correct me if he thinks I'm misspeaking here, we're talking about like the hairy edge of what's happening in these markets to help understand where they're going to be heading in the future.
No, exactly. I mean, I've ballparked from the commodity flow survey that just truckload shipments each year. And this was in 2017. A lower bound was in 225 million in the U.S. every year. So we're talking per business day about 1 million loads a day at least. And so you start factoring these in, Ken, just like you said, we're talking small changes, but they can have huge ripple effects on pricing. I mean, the one sector we never talk about, because before COVID never fit us, was bulk shipping, bulk ocean shipping. And the joke always is if you have 100 cargoes and 98 vessels, watch what happens to price. It goes through the roof. You flip that around with 100 vessels and 98 cargoes, prices will plunge. We never experienced some of these dynamics, but then we got to in 2020 in the back half and in 2021 when freight networks were discombobulated. We had hit a lot of capacity, demand surge back. And at the end of the day, trucking costs are a very small percentage of most value of shipments. Take food manufacturing. It's about 4% of the value of a truckload shipment of food is tied up in truckload costs. That means as a shipper, $3.30 versus $2.50. At the end of the day, I'm not delaying that shipment because prices are expensive. I'm shipping it. And that's what gets you the possibility for rapid increases. But then when that market turns, things come back.
That's an excellent point. I was just having this conversation with our marketing department the other day. It's like when you talk to a freight broker, you talk to a carrier, you go to lunch with them, you play golf with them, you have dinner with them. The entire conversation is about freight, right? It's about capacity. It's about truck prices. It's about spot rates. It's about contract rates. It's about all that. When you go visit a shipper, one, you're probably not going to dinner because they have like a $15 limit on what they can accept as gifts. And secondarily, like they're concerned about raw materials and interest rates and payment terms. And yeah, they're talking to you. And this is hearkening back to my time in industry, not just here. Like a sliver of their pie is dedicated to shipping, even if they work in procurement and logistics, right? They're worried about a lot of things. They might be worried about intermodal, truckload, ocean, raw materials, packaging, accessorials, dock help, scheduling, warehouse management. So it's everyone has a very, I guess, not want to say divergent interests, but just different interests in this market. And that's what I think keeps it so interesting and so fun and so interesting to study and talk about.
No, I would agree. And I think that's a big thing. One of the biggest misnomers, I think, is I've heard many people attribute substantial shares to the inflation that we've experienced to, elevated ocean shipping costs or elevated truckload costs. And I'm just sitting here shaking my head going, no, not one. For food manufacturers, truckload costs represent 4% the value of shipments. Food's more expensive because commodity prices are high for various different reasons. Same way on the ocean side, the San Fran Fed estimated that roughly 11% of consumer spending is tied to imports of all types. And remember, we still import a tremendous amount of oil, for example, from Canada. So I think there's just this big misnomer that these transportation pieces are what are driving inflation. And I bring that up to say, even though we've seen truckload rates come down, even though we've seen ocean spot rates come down substantially, that doesn't mean we're going to be moving into some like deflationary cycle because of this. This is a very small sliver of the pie, of the inflation pie.
Yeah, I mean, 2 points on that, then we'll get to questions. It's much more glamorous to talk about the ocean backlog and ocean shipping rates driving inflation. It's much less glamorous to talk about chicken feed and bird flu making your eggs $7 a dozen, right? That's what's really driving the cost of eggs. And in part two, I do want to offer a little bit of sympathy here because if your food service cost, if your cost of food goods is 4% of transportation, whoever's in charge of transportation, that's 100% of their world. And I guarantee there's someone in that chain thumbing down on them to get it down to 3.8, right? So, that's what I mean about these divergent interests. It's like in a macro level, yeah, the CEO of that business is probably less concerned about shipping than raw materials costs, but someone has a boss that is very, very concerned with that 4%. And why did it go up to 6? And they're happy it's now back down to 4 or 3.8 or whatever it might be. So, all right, let's get to a couple questions, Dean, real quick.
Yeah, Gary Bates asked, and I'm not sure I understand the question fully, Gary, but we'll have a go at it. Should carriers demand higher spot rates or wait for brokers to give gifts to their favorite carriers?
My response to that is spot rates are determined by the market. There's nothing a carrier can do to command it. You're putting on my economist hat. You're a price taker, not a price maker in this market. So there's nothing you can do.
Yeah, I mean the spot rate is set where supply meets demand, and if more carriers are saying no than they were yesterday, you're going to theoretically see the price go up. And if more carriers are willing to take lower price shipments, you're going to see the price go down, right? A broker's not going to pay, or a broker or a shipper is not going to pay you more out of the goodness of their heart, right? They're going to pay what you or one of your counterparts is willing to accept. And if your buddy, one parking spot over at the TA, is willing to haul freight for 5 cents lower than you, and you're both looking at the same shipment, they're going to get that load.
Right.
And the guy 2 spots down willing to haul it for 10 cents less, it's going to go for 10 cents less. They're not going to, unless you run into a rather unseasoned negotiator on the brokerage side, which anyone who's worked in this industry can tell you there's a few of those around.
And it's also
and one thing I would even add to that too is it's important to recognize certain lanes are going to be very price sensitive to market conditions, but others won't. I'll just take a stab out there, and Dean and Ken, tell me if I'm wrong. Freight going into Southern California, the price for those movements hasn't really fluctuated that much throughout the cycle, but the freight out of Southern California fluctuates a tremendous amount because of the balance of supply and demand. And so you have to take that into consideration, that sort of your classic head haul lanes out of regions that have more outbound freight than inbound freight are going to be very volatile based on market conditions. And vice versa, shipping into New England, those prices into New England very much will fluctuate with market. But out of New England, there's so few outbound loads, it's going to typically be fairly low pricing that's far less volatile because carriers just want to get out of there.
Yep.
And even though those seem like simple dynamics, when you start thinking about it on a lane-by-lane basis, if you're a small operator, that affects how you have to think about bidding for certain loads.
Right.
Yeah, I mean, there's never a downside to being more informed about where the market's headed, right? And I'll be a homer for a second and say we have plenty of tools for small carriers to understand when capacity is loose and when capacity is tight. And more importantly, when capacity is loose, where you could go to find higher paying load, right? And I think this will probably answer the last question kind of in a more macro sense. It is slower than last year for sure, but I'm going to make no mistake. I've visited with a lot of customers over the last few weeks. I've talked with dozens and dozens and dozens across the entire spectrum. It is by no means people sitting around twiddling their thumbs, right? These retailers, any seasonal affected business right now is rocking and rolling. Is it slower than last year, which was like the craziest nothing on the shelves, credit cards melting into card readers year on record? Yeah, of course it's slower than that. But let's just dispel this fallacy that no one is moving freight, because there's a ton of freight moving around. Is there less than last year? Yeah. Is there still probably more than just about any other year on record? Yeah. Probably. So I sympathize with folks that are slow. Maybe right now they're on the margin, or they're not. Their cost structure is not set up in a way. But it is still proving to be a rather healthy, if not a little bit slower, peak season than years prior.
Yeah, my statement is we have more freight volume now, at least per our 10-mile index, than any other time other than last year, even more than 2018 in the back half. From a pure industrial and manufacturing side, there's probably not as much freight as there was in the first half of 2018, which was sort of, I'm going to say, peak U.S. manufacturing post Great Recession. But yeah, Ken, just like you said, it's not like there isn't freight flowing. I mean, and I'll tell you, looking at the local mall around me, I think part of the change is people are shopping more in the stores this year than they were last year. I've never seen parking lots at Target, Macy's, Dick's Sporting Goods, and the local bookstore busier than I have the last couple weeks.
Yep. Yeah.
Yeah, I agree. And I think people are probably spending more on some of the lower price items, right? You know, they're not buying Pelotons by the six pack this year than they were years prior. They're probably buying, you know, the Nordic track. I have no idea about exercise bikes, but they're probably buying more lower ticket items, which, you know, probably is benefiting that retail slant, especially the more discount retailers. All right, we got to wrap up. We'll be here until Christmas. Dean, bring us home.
All right. Sales chatter tomorrow with Dan Deegan, 9 a.m. Eastern. Connect with him on LinkedIn. Robert Rouse from DAT will be on Landline Now tomorrow on Sirius XM at 7 p.m. I'll be on Radio Nemo with Jimmy Mack, 8 a.m. Eastern this coming Thursday on Channel 146 Road Dog. We'll also be on Christmas Day with Jimmy Mack for their Christmas Day special. Basic theme is if truckers are working, so are we. And also you can find more about this week's market update. Don't forget to go to DAT.com/market update and download our weekly report, which will be up this evening. And with that, it's back to Ken to wrap up the show.
All right. So this is our last show for the year. We'll be back a week or two after the new year. We're going to take a couple weeks off of this program. But you'll be able to find all of our content and stuff like that online. I want to thank Dr. Jason Miller for joining us. We're both going to be pulling for the Buckeyes here in a couple weeks. I know that for sure, and hopeful that the Spartans will be on the upswing next year. I want to thank all the folks that engage with us and watch this program. It's been a really, really great year. We have some super fun things planned for next year as well. And I think most importantly, we want to thank all of those carriers out there that maybe aren't getting a break over the holiday, that are really out there running and spending time away from their families to make sure that we have presents to open and food to put on the table to host our friends and family and loved ones. So thank you very much on behalf of us, on behalf of DAT, on behalf of the industry as a whole. And we hope you all have a safe and enjoyable holiday, and we will see you in 2023. Bye, everyone.
Bye.